In the latest issue of the Business Today magazine, we take a closer look at how companies have been forced back to the drawing board, with shareholders increasingly asking uncomfortable questions and setting the tone for greater accountability and transparency in India Inc. Listen in to a conversation I had with this expert panel on shareholder activism and whether it's here to stay.
You know, while we are focusing on obviously the larger companies, the better known ones, and there are many others. I mean, let's say the BT top 500, for instance. Okay, now you have these companies where a lot of this discussion is happening. There is a huge number of mid-size and smaller companies.
Exactly.
I'm not sure how much of activism is actually happening. I mean, taking off from the point which you mentioned about newer shareholders coming in, newer investors coming in into the market. And many of these so-called multi-baggers, which are sort of hitting new highs in the smaller and, you know, even smaller size companies, very small companies. I mean, there are shareholders there too. Are they raising enough voices? Are the proxy investors, proxy advisors looking at them? Are institutions looking at them? We would like to know what's going on in that space as well, you know.
Absolutely. Who would like to jump in?
Yeah, I mean, because it is for proxy advisory firms itself directly to us. I mean, see, obviously, we will go where the investors are, right? I mean, at the end of the day, and that is fair to us, where the issues are. I mean, be it a 100 crore market cap company or a 500 crore market cap company, if an investor is there and seeking for some redressal, we will definitely help. So that is the response. We, in fact, this year have worked on a couple of cases where very activist shareholders in just a 500 crore market cap kind of a company, we have helped such a shareholder. But of course, the outcomes, I mean, media doesn't cover it. Those kind of issues are there. That's a different matter altogether.
Okay, we'll continue to discuss that one offline. But closing comments then.
I guess it kind of factors into your risk appetite, right?
Yeah, go ahead, Sudeep.
No, I was just saying that it also, if you're going to chase a multi-bagger small company, then you're obviously, your risk appetite about governance is probably should be higher. If you are a little more conservative, then perhaps it's better to stick to the bigger companies which now have much more scrutiny, and you know, your chances of burning your fingers in this are lesser. So it kind of also, what returns you're chasing, what your risk appetite is, should decide what sort of company also you are, you know, pursuing.
Rakesh Jhunjhunwala's Akasa has decided to fly with Boeing. The airline has placed a massive order for 72 of the 737 MAX aircraft. The order has been pegged at $9 billion and includes 737-8 and high-capacity 737-8-200 aircraft. The order puts the airline in direct collision course with bigger players like Indigo, SpiceJet and Air India. The order is also a big boost for Boeing, which is a distant second to Airbus in the Indian market. This is amongst the largest aircraft orders after the pandemic. Mensah Brands becomes India's fastest unicorn with $135 million in funding within 6 months of launch. The brand's aggregator and roll-up firm, founded by former Myntra CEO and MedLife co-founder Anant Narayan. Bengaluru-based Mensah has raised a total of more than $300 million in equity and debt. The firm has been valued at over $1 billion in the latest round of funding and is the 36th startup to achieve unicorn status in 2021 in India. Mensah kick-started its journey in May 21 with a vision to partner and invest in digital-first brands across fashion, home, beauty, personal care and food, and scale them exponentially. Company runs a model similar to the US-based Thrasio. It has acquired 12 brands so far in categories such as designer saris, jewelry, menswear, smart devices and personal care. Good news for those travelling by trains. Passenger fares could fall by as much as 15% in the next few days. With COVID largely in the rear-view mirror, Indian Railways is looking at normalizing its operations as much as possible, and that also includes a reduction in fares.
Your travel budget for the next trip home or for a holiday could be much lower than what it is today. In a big move, Indian Railways is normalizing its operations, reverting from the special trains and services it was running during COVID and the subsequent lockdown. In a letter to the entire network, Railways had ordered that all trains will now be operated with their regular numbers and fares will revert to normal pre-COVID prices. Since COVID, all normal services had been scrapped and trains were being run only as specials or holiday specials with corresponding higher ticket prices. With the decision to revert to normal services, the ticket prices will fall to normal, which are around 15% lower. For railways, COVID has been a particularly difficult time and its financials have literally been derailed. There has been a recent uptick with 118 crore passengers travelling by train in the April to September period. This is exponentially higher than the figure last year, but still very low as compared to 2019. The revenues have been correspondingly falling, with the railways still struggling to cover its expenses. With the latest order, services on 1,700 trains will be normalized. However, passengers will still not be provided cooked food and platform ticket prices will still remain high to deter crowding at railway stations. Bureau Report, Business Today Television.